Hello, good afternoon, everyone, and thank you so much for joining us today. If you guys are wondering who are these random people on stage, we are from the Daily Ketchup podcast, as mentioned, and we basically host a bi-weekly podcast on YouTube and Spotify, and we talk about topics that are aimed at relatable things that are relatable to everyday Singaporeans. So things like current affairs to relationships to politics and also personal finance, which is why we're here today. A word of warning. Even though we've done many episodes of the podcast, almost 2 years now, this is actually the first time we're doing a live version of it with a live audience. So give chance lah, huh? Let me introduce my co-host, starting with the man on my left, Jonathan Paul.
Hello. Sorry.
Very bassy. I like it too. I also got Denise O.
Hello.
I'm Daniel, and as mentioned, we have with us a very special guest. She is the CEO and CIO of MoneyOwl, Chun Ting Weber. Thank you for joining us. All right, so our slot is only for 30 minutes, and I just drank a lot of water in the green room, and I have a very, very weak bladder, so most likely won't overrun, so don't worry. If you guys are bored by the 15-minute, it should only be 15 minutes more. So let's get the ball rolling. I think first and foremost, we want to keep this light, we want to keep this conversational, and so we'll start off by an icebreaker. Maybe, John Paul, you can start off by telling us a little bit about how you started your personal finance journey and where you are today, and then we'll go down the line.
Okay. Okay, hi everybody. So, I guess when we first got invited to do this, right, then I was actually a bit nervous because I'm 31 years old right now, and I've barely started my financial journey. Like, I think it was like 2 years ago when I realized that, oh shit, I need to do something with my money. You know what I mean? You cannot just sit there. So, I started to try and learn about finance, learn about how to use my money, learn about investing, right? And I think at the end of last year, I basically lost everything. I lost quite a big sum of money, right? But there was a lot of silver lining there, and I think the good thing was that one of the principles that I stuck to was that I'm only going to invest money that I'm comfortable losing, right? So I guess that was fine, and there were many lessons to learn from that. And then 6 months later, I lost everything again, a lot more. So right now, again, for context, I'm kind of like 1.5 years into my financial journey. I have made 2 losses. I've made a lot, but I've also lost a lot. And so I'm really trying to figure out at this point, where do I go from here? So yeah, that's kind of a bit of background for me.
Thank you for sharing. That was like a therapy session. So sorry for your losses.
Did you actually sell and crystallize your loss? Or is it a paper loss?
No, real one.
Real one, okay.
Realized losses. How about Denise?
So actually on the note of paper trading, I think that's not how I started. I started when I was very young, I think, actually right out of JC. So I had saved up about, I think, $2,000 at that point in time, and then I thought, okay, let me see what I can do with the markets and all that, right? Since we are preparing, recession is coming, and it did come eventually in the form of COVID. I mean, not a recession, but a big crash. Yeah. So then I did start with leveraged ETFs. So probably not ideal because it is such high risk, but at the same time I thought, okay, ETFs, that's pretty safe. So I'm taking a calculated risk keyword. So
Leverage calculated risk.
The leverage.
But what turned out to happen is that the stock delisted. So it's the worst thing that can happen. I lost my $2,000, and then to me at that point that was also everything to me but 2,000 is a lot less than my friend over here. So condolences to him. Yeah. So since then I've been trying to learn a bit more about finance. I just turned 24, so I think I'm still on that journey of learning how to grow my money. But I have a bit of a dilemma between should I be saving more for say when I want to get married, I want to get a house, or should I be putting more money into investments where I grow my money faster and reach these goals faster maybe? Yeah.
It was a $2,000 tuition lesson of sorts.
Yeah, my mother would not be happy with it.
So for myself, I've had a love-hate relationship with finance. I was lucky enough to start early because of my dad. He's very astute in terms of investments. And so I'm 30 this year. I started as early as I was 18. That was when I got my first brokerage account. But I invest, or I'm very involved in my personal finance in phases, in waves. So 1 month, right, like I will be so into it, I'll be doing Excel sheets and everything, and then after that, like 6 months later, I realized, oh no, I haven't kept track of anything in so long. And so where I am right now is that I was very, very diligent up until about maybe 2020, and then I think greed started to creep in, and then I started becoming a little bit more risky in terms of my portfolio. And then when the market kind of downturned a little bit, this is where I kind of got emotionally scarred a little bit. So even though I've been investing for like 12 years, got very emotionally scarred, and I still felt like, oh no, how come I'm still reacting like this, knee-jerk reactions and so forth. And so I guess I'm here hoping to learn more also about how I can build that emotional resilience when it comes to like investing. So how about you, Chun Ting?
Yeah, so you guys are really young, and that's a great asset, and we can talk about that. I actually started not knowing very much about money. I would echo something that my friend told me recently. She's a long lost JC friend. She said, Chun Ting, I need to talk to you because all my life I only learned how to work. I never learned how to invest. So that is more or less me. And I actually studied history at university, and then I went to work in the Ministry of Defense doing diplomacy, policy work, and all that, right? Then after 9 years, I stopped. And my husband that time happened to work for a company that IPO'd. And that was 2006, so you can count how old I am. So I had a year out and didn't know how to invest, So I had a very advantage of having a friend's mom who has been investing for a very long time. And so she sort of taught me. But it was really sad, because like I want to open a brokerage account, right? Then, when you want to buy share, then don't know whether should put one for one lot or should put 1,000, that kind of thing, It's so basic. And that's what I didn't know at all. So when she started guiding me, she started to talk to me about, say that, don't be scared, because there was a mini crash in 2006, and she said, you can go and buy, these are quality companies, and this is the target price, this all that. So I'm thinking, who sets these target prices? And all that. Then I realized that these were all broker analysis and all that. So because I was taking a year out, what I did was that I said, okay, let's learn, right? And because I'm a kind of tick type, right? So how I learned is I said, okay, I signed up for CFA, Chartered Financial Analyst Program, on self-study. Yeah? So I want to study because I want to understand how investing works, how market works, what are they all about. And I learned how to read financial statements and all that, and understand macros on paper. Yeah. So that's how I started. And when I went to take my exam, I ran into an ex-colleague who's just started at a fund management firm, and that time was 2007, just before the big crash. And then they said, we are looking for people. Would you come to try lah? So I went to try, and my boss then took a chance on me and said, let's try. Let's give it a try. And that time I joined the structured credit team. I don't know whether you all heard of things like CDOs last time. So I joined the CDO team, and then they said, you are a rookie as a credit analyst, very, very stable. Please take care of global banks. Citibank, Goldman Sachs, Lehman Brothers. How bad can it be, right? So I took care of that. Yeah, and of course, I learned a lot. I had a ringside seat, and that's when I understood some things about investing and some things about leverage. And from then on, I moved on to do asset allocation. And after crisis, life becomes a bit boring. So then I went to work at NTUC Enterprise to look at the corporate and business side of things and do some good lah. And ended up then also in Singapore Labour Foundation as the CIO, managing the foundation's funds. And in 2017, 2018, NTUC Enterprise asked me to sort of go back to help set up a financial advisory firm that is fully independent with non-commission advisors who don't take commission, and also to use technology to reach everyday Singaporeans so that to enable everyone to live their best possible life through making wise financial decisions. So that's where I am today. So it's really happenstance. It just happened that I sort of fell into it and had the privilege of learning.
Very serendipitous, I would say.
Yes, that's right.
I think you mentioned, so like, we know that you are a CIO. besides being CEO at MoneyOwl, what is exactly a CIO?
Yeah, so CIO in a traditional fund management context is the person who looks at all the investments and set the investment strategy, determine like what kind of outlook you have and how you invest your money for your clients' benefits. Right? So in the context of MoneyOwl, we are primarily a financial advisory in this office. So what we do is that the investment side sets up investment portfolios as sort of advisory portfolios that are suitable for investors according to their financial plan. Right? So we don't do a lot of investment work because in our investment philosophy that investment is not an end in itself. Investment supports your financial plan supports your life plan. So we are one in which fund management returns to its roots, retail fund management returns to its roots of putting the investors' life plans right at the top of the agenda.
Understood. Okay, I think before we move to the next segment, I actually wanted to get a sensing from the crowd. So like, help me put your hands up a bit, okay? I wanted to get a sense, right, of what level everyone is at in terms of their like investing or like personal finance journey, right? So, a bit difficult to like say beginner or advanced, but like how many of you have been investing for at least 5 years already? Put up your hands. So 5 years or more. Okay, so quite a fair bunch, and I'm guessing the rest is less than 5 years, or you all didn't want to put up your hands? Okay, to get a sense also, how many of you have not started investing yet? Okay, there are some, and the rest of you less than 5 years. Okay, so that's quite an interesting crowd for us, and to lead into the next question that I personally wanted to ask, because I know I made a lot of mistakes when it comes to investing. What do you think are typical mistakes that people make, especially those who are probably new to investing? What do they typically make when they first get into investing?
I think that the most common question that I get asked is, buy what? What stocks to buy? What's your hot tips? Right? Actually, that boils down to what we think investing can get us. So some of we think that investing is that get rich quick kind of thing, and because we hear a lot of stories of this, but we don't hear a lot of the downside stories, right? So there is a lot of that greed-driven, this misunderstanding that it is actually sustainable and possible to make huge outsized returns that will make you a millionaire overnight, or maybe in 2 years lah. Right? So, like I talked to my 12-year-old son about investing, then he said, "Oh, so what is the return you can get?" Then he said, "Not next month lah. Cannot double next month." So I think sometimes we try to think that investing is a silver bullet, because we hear so much about saying let money work for you, you don't work for money, and that wow, that's so attractive, right? But it's actually quite a deception, because that's not how markets work in the short run.
So actually I have a question regarding that, right? Because if we talk about looking at long term, I think like a very famous quote that maybe a lot of us have heard is, time in the market is better than timing the market. But if say like my investment goal is in like 3 to 4 years, I'm about to buy a house, then in that sense, isn't timing the market a lot more important for me, right? And then how do I balance this out?
Yeah. Now, timing in the market is, the timing at which you enter is not unimportant. The problem is you cannot tell. That is the problem, right? You cannot tell because markets go up and down, and they can do one thing today and they can do the other thing tomorrow. And if you could tell, then great, but you can only tell in hindsight. Just now the speaker showed, like some of the ups and downs and all that. And that is the main problem. Now, a lot of people think they can do timing the market. And how do they do timing the market? You look at the macro and you say, okay, I think can roughly so, and then I'm so smart, and I do quantitative models and all that. The problem with the market is that the market is very fast. The markets are fundamentally efficient. You have millions of participants in the market, and if you have done this statistical exercise, I put a jar of beans in there and I ask you, count how many beans there are, and all of you guess, and actually the average guess is likely to be correct. Right? So this is just the nature of information. Markets price all the information and all the expectations about whether interest rate going up, going down, inflation this way, that way, and all that, and they incorporate into the price very, very quickly. And a lot of times people look at, say, economy is so crap and all that, right? And if you read Bloomberg, there's an opinion writer called John Authors, and he said that every time the cover of Bloomberg Business Week is very, very gloomy. It tends to be just before the up. Right? And if you look at previously, be it the global financial crisis or even the 1980s, so I think you're not born yet, the savings and loan crisis, it seems that the stock market moves ahead about 6 to 9 months before the bottom and can feel very, very jalat, right? And sometimes the dawn is darkest before before the light comes, and that's why you cannot tell. That is why it's not that timing is unimportant. Of course, it's important. It's just that you can't tell. But time in the market, you know, because compounding, and you can ride through it, right? The compounding is magical. Right? And in the inflationary environment, I want to tell you that compounding works against you. You cannot tell, you cannot prevent from being exposed to the compounding effects on prices, which is inflation. If there's inflation 7% a year, say in healthcare expenses, it means that whatever you have today, the bill today will be twice as much in 10 years' time. Then it is up to you whether you want to take the other side, which is to grow your money also at a compounding rate. Yeah, so time in the market is indeed your best friend. So for all you young people, it's really, you know, it's something you should really consider. 3-4 years. So 3-4 years, I would say that I have people who come to me and say, I'm going to buy a house in 3-4 years. Should I go and invest my CPF OA money and then in the markets and earn get more to down payment, right? That's like, okay. So if you did that 3 years ago, what would have happened to your CPF OA?
Not a big success.
Right, that's right. So time horizon determines your ability to take risk. Because in the short term, you are volatile. But in the long term, the market goes up. Right? So if you look historically speaking, if you exclude the Great Depression, an investment in the S&P 500, in any time period, no matter how sway you are in your timing, after about 10 years or so, you're kind of okay. After about 15 years or so, that is more like kind of safe lah, right? So we're not saying it's a magic figure, but you need to have that risk appetite and the risk ability. The ability to take risks is one of the most important things, and that's determined by your time horizon. So you want to be, what is more important to you is buying the house. Then what you need to do is to preserve that ability, right, and plan around that. What you don't want to is you lose 20%, then you still can buy only a smaller house, especially if the house prices go up. Right?
Yeah, I think the other thing as well is like the importance of, I think you mentioned time horizon, but also to zoom out, because like oftentimes like now we have all the information that we have on our phones, right? We're all like using stock apps or like, you know, things like tracking the market prices, and every day we're just looking at the plus minus, when in actual fact, zoom out. Look at the 10-year horizon, for example, and sometimes
I often zoom out the chart to comfort myself.
Yeah, I think that was what Kristan was saying, right? You know, you see that zoom out. Actually, the better thing, don't look. Right. So you were saying in 2020, right? You started investing. So if you invested in the, let's say January 2020, then after COVID, it went down so much, right? Then after that, it went up 200%. So imagine you went to sleep lah. You know, in January, then you close your eye, you know, do something else, you come back. 2 years later, actually, you have done well. So actually, one of the worst things, right, is news. You watch CNBC or whatever, please know that news is there. The news needs viewership. Viewership likes bad news. They like to be excited. Right? This is news. Right, this is what they do. Cannot keep telling you, hey, relax lah, don't be sad. They want controversy and they want to excite people, and there's nothing more exciting than doom and gloom, right? Sometimes. So I always call you know, some of these things that you watch late night a bit like financial porn. You know, you just watch and then it's just please don't, no need. Right? So sometimes we say please don't watch don't watch your portfolio too closely. What you need to know is that when you invest according to your risk profile and your need, including your need to take risk. So there are actually 3 elements. I talked about your ability to take risk just now, which is your time horizon. It's not necessarily your age, it's your time horizon to your goal. Right? Then there is your need to take risk, which is that how much return do you need? Like, let's say you have a long time horizon, but actually you don't need to take the risk. Then why take the risk, right? And then your tolerance for risk, or your willingness to take risk. So this is an analogy that I learned actually from my friend Chris Tan. Is that the stock market is like a roller coaster. The stock market is like the Battlestar Galactica in Universal Studios. So it goes up and down, but it's very, very thrilling. Right? So that is like your full equities portfolio. It's hugely volatile. You can be up 30%, one year you can be down 20% or 40%. Right? But unlike a normal roller coaster, you know you are strapped in and all that, right? No matter how you scream, as long as you get on it, you come down, you'll be okay. The stock market is a roller coaster that has a stop button on it. What happens when you stop in the middle of the centrifugal force? You die, right? You fall to your death. Right? So this is the problem. The stock market is a roller coaster with a stop button. Right? Because you sell. Right? Just now I asked you, did you turn your temporary decline into a permanent loss? Not the good. I'm not sure what you invested in, right? But if you are unable to take that, then that's when you add bonds to your portfolio. You don't go all the way, and you accept a lower average return, because the most important thing is not to interrupt the return. The money makes money, that then makes money, and then it makes more money, right? That's compounding. And the worst thing you can do is not to select a lower return instrument or portfolio. The worst thing you can do is to interrupt that. So that is why your willingness to take the risk is very important, and your mettle is tested in times like these. Yeah, it's times like this.
So earlier you mentioned financial porn, right? Then that really got my attention. Because like for me personally, right? Like I'm scrolling through social media all the time, and I see like TikTok accounts where they have these like financial experts telling you what to do, quick bits of advice. But they're also playing the social media game. They're trying to retain your attention. They're trying to give you bits of information, but maybe not the whole picture. So I'm kind of curious as to like what are some like credible sources, or even just like sources that I should be using or accessing to understand more about finance?
Yeah, I understand that. I mean, as a kind of fintech, MoneyOwl is also very involved in social media, and we do see communities coming around to discuss ideas. I think one thing that we need to know is that many of the people on, say, TikTok, etc., are they're influencers, or they are paid to do some of these things. Right? So they are not licensed advisors, so you need to be aware of that. The other thing is that sometimes you have to look and see what is the motivation of this person, like what is the position of this person. Like is it telling you, if they have a certain agenda, then I guess you sort of must have your eyes open and know about that. So I think where credible sources, I mean, MoneySense is an education program by the government, right? Now I know people think government very boring and all that, but there's the interest of the at heart of citizens, right?
Your best interest, yeah.
Yeah. So okay, I think the issue with like government sites or that, they won't give you very specific advice, and they won't give you like. They might say this is introduce you to the concepts. Ultimately, you have to take advice, and the advice. Well, firstly, look out, see whether it is a licensed entity. Then look out for signs of conflict, right? In the sense that if people are pushing you a product, is it because they are compensated by that kind of product in some way? And I think you still also have to do your own homework. Like proper education about learning about all these things. And sometimes when the return is too good to be true, it likely is. Right? Likely is too true. So I think MAS has a ask, check, confirm kind of suggestion. Also, when you talk about a firm, you ask, check and confirm its status, whether it's licensed, what it's like. Then, of course, then you look out for conflict of that company or the person, and then you can cross-check together with the others, with the government websites and information sites, and ultimately, if it's too good to be true, it's too good to be true. So I give you a handle, all right? The long-term return of the, say, US stock markets or global stock market is probably around 7%, 7, 8, 9, right? It's very easy for people to cherry pick certain return periods, certain countries, and all that, and tell you 10%, or whatever, in 3 years, right? If that happens, right, I think you just need to, think about it. Like something that's too good to be true normally is too good to be true.
Okay. So then there's this other thing, because I was reading up, right? And there are these 3 categories, which is like financial planning, investing, and then insurance. So I'm kind of curious, like, what are the core differences between the 3? And more so, at which stage in my financial journey should I place more emphasis on any in particular?
Yeah, financial planning, I guess, is the umbrella thing. It's like you're saying that I'm building a house. Okay, so you build a house, you need to lay a foundation, you need to have the structure, then you need to put the fireproofing and all that. So financial planning is the overall thing that you do. Now, ideally, right, you should try to plan, set out the whole thing, what your goals are, your vision, and etc. Then you go into the individual rooms and try to populate them. Insurance and investments have their role in your house, in your financial house, right? But they are not all to financial planning. Budgeting, your own way of saving, how your habits, that's a foundation. Financial health is a foundation, right? Then there is when you start to say, okay, and in Singapore, this is one of the, I would say it's also a financial planning mistake in the sense, I go and buy product, because I'm very product-centric. Financial planning means collecting all the best products. So like I was telling you, a lot of people say, hey, what to buy? Then a lot of the second thing is, hey, which insurance policy to buy? This one good or not? How do you know whether something is good or not? Something is good or not might be good for you, may not be good for someone else, right? I mean, there are broad characteristics, but insurance and investments are products, they are instruments to implement your plan. So financial planning is a whole process, and it's a continuous process, and financial planning supports your life goals. Investments tend to be about growing your wealth, growing what you have, and for the long-term returns to support maybe a future life or a specific goal. Your insurance is protection. Right? So insurance is something that at different points for different purposes you need different types of insurance, but insurance is for protection, is an expense, buy as much as you need but pay as little as you can. So that they have different functions. Insurance is financial planning. One of the most important things is to plan for your plan not to go according to plan. Right? And one of the things that can cause your plan not to go according to plan is when risks like medical crises happen, if you have dependence, if death happens and all that. So those are roles that are different. Right? So accumulation, investment is a very powerful instrument. Insurance, let's just keep it simple, low cost, to protection needs. And always review your whole financial plan.
Okay. Understood. Thanks so much for that answer. So I've just gotten the signal that it's been 1 minute left, and so I unfortunately need to wrap things up. But if you're interested to find out more, Chun Ting will still be involved in the next panel, I believe. So there's still an opportunity to hear more from her. And if you want to listen more from us, hopefully you can check us out on our podcast on YouTube and Spotify. That's the Daily Ketchup. So thank you so much, Chun Ting, for joining us today and for answering some of our questions. Thank you all of you for joining us today. And stay tuned for the next one. All right. Bye-bye.
Thank you.
Bye-bye.